Tom Lee, Fundstrat Global Advisors Managing Partner and Head of Research right now. And Tom, I mean, you've been pretty spot on all year in your calls here. Talk to me about what your expectations are now after we got the unemployment update today when it comes to that jobs report tomorrow.
Well, we work with this big data macro research firm called Deep Macro, and they've been calling for a big payrolls beat for November. Something in the million jobs range. And I think today's jobless claims really seem to support it. What they're saying is that the fill rate, the speed at which jobs are being filled is quite fast. So the labor market's probably a lot stronger than we think, especially given all the soft lockdowns taking place.
Tom, you've of course been highlighting, like so many others, this rotation that we've been seeing in the markets out of growth into value. A lot of that driven by some of the optimism around the vaccine news. When you look at some of the data that came out today, though, what do you think that suggests in terms of how sticky this is? Is this one of those things that continues even with the slowing momentum, at least in the labor market, just given the light at the end of the tunnel, or you think we could see a bit of a reversal?
It's tricky. I mean, we've kind of had many false dawns in value, and I've been fooled many times thinking the rotation's going to happen. So I think we all are kind of on rotation watch because it's been 14 years of growth, massively beating value. But there does seem to be some real underlying momentum in the economy, believe it or not. And I think it's the labor report's sort of evidence of that. But I think if it really is going to have traction, it's because all these cyclicals, which we call epicenter stocks, have become turnarounds. They had to cut costs so dramatically this year. They've reset their whole business model, cost engineering. I just think that operating leverage is what's causing these stocks to act so well.
Yeah, Tom, I mean, you've been talking about that rotation for a while now, and we've seen that, and you've kind of pointed it out when you look at the Russell value versus growth indexes there, kind of the rotation, as you've been talking about outperformance and rollover that you haven't seen since going back to, 2008 there. So, I mean, there are concerns when I think about the cyclicals and some of those bankruptcy risks that are kind of, you could say, maybe being overlooked, maybe using the cruise stocks here as a proxy. Bloomberg was out kind of noting that companies, junk-rated companies that are losing money even before paying their interest payments doubled in Q3. That number went from 26 to 47. So, I mean, I guess when we talk about that, we know we're going to get back to normal at some point when these vaccines roll out. But don't you think that the debt burden on some of these cyclical stocks is going to be rather large and weigh on growth once we get back to that normal?
Yeah, I mean, we're in a tricky period. Because we can either rely on, the contemporaneous data we're seeing, like exactly what you're pointing out, or we can look at the signal from markets. And to me, if credit markets were telling us something, spreads are really tight, the volatility in credit indices are really low, and even the CDX, the credit default swaps are behaving. So they're saying that credit investors are not troubled by all the contemporaneous data you're pointing out, including rising bankruptcies. In fact, they might even be saying that we've already peaked in that cycle. I mean, it's something JP Morgan wrote about over the summer, that the credit cycle in terms of defaults is probably already peaked. And if that's true, then the equity investor shouldn't focus on the bankruptcies as much as the fact that credit markets are functioning really well and spreads are tight. And that's good for risk premium. So I think multiples are going to go up a lot. That's one I think people would be surprised at, is value stocks could get re-rated pretty dramatically. And that's why 2020 highs isn't the ceiling for the stocks.
Tom, how are you looking at some of these travel names that we have seen gain on the back of the vaccine news? You look at some of the airlines, for example, we saw a big uptick, of course, during the Thanksgiving weekend. But today we get this news from Delta also saying there is a bit of slowdown that's happening, also cancellations that are picking up as well. What do you think of some of those names as an investment? And is it worth putting your money behind that in hopes of things ultimately picking up, whether that's 6 months from now or a year from now?
Well, I think that a lot of travel businesses don't have long-term substitution, meaning, the pandemic is completely destroyed any ability for us to have normal lives and travel. But we have to think of, in the post-pandemic world, are there going to be competitors to cruises, destinations, to theme parks, to airlines? And if the answer is no, then these companies simply just have to reignite demand. And if we're talking about a 12-month period where we're in that gray zone where we don't know, that's the opportunity for investors, because I don't think there's intermodal substitution for any of these. And so that means they're going to come back, roaring back at some point with much lower cost models. But you're right, we're not buying it for next quarter's earnings, because they're going to be awful for the next couple quarters.
Yeah, and I guess, looking past those, as you pointed out just a bit ago, it does seem like investors are looking ahead to that recovery, but I don't want to look too far ahead. We had Morgan Stanley's Mike Wilson telling Bloomberg this morning that stocks look like they could be setting up for a correction at these levels. As I said, you've been right all year and kind of calling the levels to watch here. Earlier this week, you were pointing out the data has shown that when you've got year-to-date returns of 10 to 15%, generally through November, December is 100% of the time up, averaging about 3.3% returns for the month. So, when you look ahead here over the next kind of months timeline, what are your expectations of potentially working in a pullback here?
I think a pullback could happen. I think even this week was a little shaky, the start of this week, but our view is strong markets stay strong. So we were strong into December 1. There's no reason for markets not to finish strong. In fact, history, as you point out, really strongly supports that it's kind of sounds bad to say, but 100% of the time, December is an up month. And so 3,800 is a pretty reasonable level, which is a lot of upside from here. But I think part of the reason we could do this is in our clients with institutional investors and portfolio managers, we just meet a lot of skepticism. They're skeptical of the vaccine, that this is unusual to have a vaccine rolled out so quickly. The logistics, people point out about the temperatures required for the Pfizer vaccine or the unwillingness of people to take it. And they just think that everyone's too optimistic. But when everyone says everyone's too optimistic, that means everyone's skeptical.